Hi guys, welcome to accounting. Today we're going to be reviewing what we have learned about general journals, and we're going to be learning how to prepare a chart of accounts for a company. So what are the advantages of using a general journal? Well, mainly there's four. The first one, the journal provides a chronological record of transactions. The journal provides a place to make an explanation of an entry. Use of the journal lessens the possibility of a recording error, and it is easier to locate a recording error. So let's talk about a chronological record. So the journal provides a chronological record by date of transactions. It's kind of like a diary for the company. The general journal is often referred to as the book of original entry because that's where your accounting takes place. That's where it starts, because you review your source documents like your purchase orders or your invoices, your bills of sale, and you record them in the general journal. Another advantage is if you need to check an entry, the entire entry can be found by referring to the date the transaction was recorded, because it's a chronological record and everything is together. If you think about it, in contrast, T accounts don't show the complete entry in this way because each T account only shows one side of the entry. The journal entry also provides a place to make a complete explanation of the transaction if needed. That's always good for auditing purposes. You always want to have a record that if an objective person comes by and looks at it, they can tell what has happened. It's always a good practice to include a description with each transaction because you can't remember everything, so it's always good to keep good written records. And also, to think about it, T accounts don't provide explanations. A general journal also lessens the possibility of error. It lessens the possibility of a recording error because both the debit and credit parts of the transaction are recorded together in the journal. That way you can see the entire entry, and you know, for example, if you have received cash for a sale, you know you're going to debit cash and you're going to credit the revenue account, and you can see them together. So if perhaps you got them backwards, you would see it easily. Also, when entries are recorded in a T account, the debit and credit parts are recorded in separate accounts, so there's a greater chance that you're going to make an error. And also locating errors, because the journal shows both the debit and credit parts of the entry, it's easier to locate a recording error. If you post it to the ledger improperly, it's easier to come back to the journal and find out what happened and to track it down. So let's look in the steps that you follow when you are preparing entries in a general journal, and you can also call it journalizing. So I took a sheet out of another accounting textbook, and this is called Journalizing in the General Journal. So you have 5 steps here, and if you look at it, you have, I'm going to go back here. The first one is you record the date. So right here, here's your date. You record the relevant chart of account number, and we're going to be talking about that in just a moment. So here's the account numbers for the chart of accounts. The third one is you record a description of the chart of account number. So the description is really just your account name. For example, 110, account number 110 is cash. And in this entry, Mrs. King was opening her business account. So she debited cash for $30,000 and she credited capital, Mrs. King, for $30,000. And also you see the description here. So in the cash account, that account number is 110, and then you have the debit, because remember you always record the debit first, then you record the credit. You will indent a little bit just to make it easier to read, and then you put the transaction description. So this is, to review, this is step 1 is recording the date. Step 2 is recording the account number. Step 3 is recording the account name. These are cash and capital. Step 4 is the amounts. And notice here, the debit comes first, and then the credit. And then step 5 is to record a description of the transaction that takes place. Now, you may think when you see a transaction, oh, that doesn't need a description, but it's always a good habit to put a description just so you have it for a record. Now, one thing that we have not done yet is over here, you see highlighted in red, it says it's important to have the pages of the general journal numbered. All the transactions are in chronological order. That means they're in date order, kind of like a diary. So we have not done more than one page of a general journal yet, but you always want to number your pages when you prepare a general journal, because that way you can keep them in order. And then you're going to be seeing, when we're posting to the general ledger in a couple more lessons, you'll see the importance of having that number there on the page. Now, another thing that we're going to be doing today is we're going to be preparing a chart of accounts. Well, what is a chart of accounts? Well, let's talk about it. In making journal entries and posting them to the ledger, the accountant needs a directory of accounts available. Well, the directory of accounts is called a chart of accounts. And a chart of accounts is mainly exactly what it says. It's a listing of all the available accounts in the company. So only the accounts listed in the company's chart of accounts may be used when entering transactions in the journal. You can't just make up an account. Once you have a chart of accounts prepared, you can't just pull a name of an account out of thin air and use it, because you have to have a record of it. Okay, so accounts are listed in the chart of accounts in the same order you find them on the financial statements. Balance sheet items are listed first. You list assets, liabilities, and then your capital accounts, and then income statement items are next, revenue accounts, and then expense accounts, and they are numbered in a certain way. The accounts in a chart of accounts follow a specific numbering system. Usually it's a 3-digit numbering system when you prepare a chart of accounts. Now, larger companies with more accounts may have 4 or 5-digit numbers just because they would need it. But normally, and especially with the companies that we're going to be dealing with in our class, we're just going to be using a 3-digit number. Now, the numbers mean something specific. The first digit represents the type of account. So remember it's a 3-digit number. So the first digit, 1s are assets, 2s are liability, 3 is capital, 4 is revenue, and 5 is an expense. And the second and third digits represent the position of the individual accounts. And usually you leave a gap in the list to allow room to add accounts later, because you can't think of everything at once, or you may buy more equipment, or things may happen in the future that you need more accounts. So you always leave a gap in your numbers so you can add more later. So for example, assets are numbered in order of liquidity, just like they are in the balance sheet. And remember, liquidity means how quickly they turn into cash. So cash is always first, and then it's followed by accounts receivable, because remember, accounts receivable, we assume that it's going to be paid off in the next accounting cycle, so it's going to be turning into cash. So the longer life cycles they have, the farther down in the chart of accounts that they will be, and we'll look at that. Liabilities are listed in the order of how quickly they're going to be paid off, just like we list them in the balance sheet. For example, accounts payable will come first because we're going to pay that pretty quickly. Then a notes payable will have a little bit longer life. It'll take us longer to pay it. And then a mortgage would be listed after that because, usually mortgages are last years. So that's the order that liabilities go into. And expenses are listed in alphabetical order, just like they are on the income statement. So let's take a look at it. Here is King's Interior's chart of accounts, and you can see with Mrs. King, let's look here just a little bit. I'm going to open it up a little bit more. Assets come first, and they're 100s. Now we're doing the 3-digit numbers. So notice that the assets are listed in orders of liquidity, or how quickly they're going to turn into cash. Cash is always first, then accounts receivable, then supplies, because you're going to use supplies pretty quickly, prepaid insurance, office equipment, office furniture, and store equipment. Now notice that there's a 10 number gap between each account, 110, 120, 130, and so on. And that just gives you room to add more accounts later. Liabilities are 200s, and you can see that there are 2 accounts payable accounts. One is accounts payable displays and accounts payable Furniture World. Those were listed in alphabetical order by vendor, and you notice that there's 10 digits between them, 210 and 220. That just allows you room to add more later. Your capital or your owner's equity are 300 accounts. Notice that Mrs. King Capital is first, and then Mrs. King Drawing is listed next, and there are 10 digits between them, 310 and 320. Again, that allows you room to add more later. Your revenue accounts are 400 accounts. You only have one revenue account in this chart of accounts, and it is 410. And then your expenses are 500s. So you see that there are 3 expense accounts, and they're listed in alphabetical order, and again 10 digits between each of them, and to give you room to add more later, 510, 520, and 530. And this is usually the normal way that you do this. Just to review, that your assets are 100s, your liabilities are listed next, and they begin, they're 200s. Your owner's equity or capital accounts are 300s. Your revenue comes next, 400s, and your expense accounts are 500s.